These downturns have been almost like the river that cuts through our profession. You know, it flows along, there are rocks in it. We learn to navigate these rocks. And in the olden days, I remember when we used to have almost a seasonal flow to the market, where the market would lift off during the spring, the warm weather, and we would all get our income tax returns, those of us who did so, and the market would kind of lift off. And we would run through the summer, and in the fall we were at a comfortable pace. And then at the final quarter of the year, it was at its lowest ebb. And frequently, the first quarter of the very next year would see a decline, a slight decline, and then the cycle would begin again. And I recall one year, not too long ago, well, memory shifts, it's probably about 10 years ago, and I said to the realtor, and usually we go through this cycle, and the fourth quarter is usually lower than the next preceding quarter. And the realtor said, no, that's not true this year. What we have is a flow right over the top. So there was no downturn during that first quarter. I was thinking, that's odd. It had always been there. You always have these rocks to the stream. And the market had increased to such a level that it had covered these rocks. And that should have been the first key that the market was becoming overheated. And to me, it's a lot like running. You start off and things start moving along, and you're at a reasonable pace. You're a little cautious because you don't know the course. You're at a reasonable pace, and you're just kind of moving along, and then you pick up pace, and you're kind of running up that hill, and you really feel great. You don't know how long this hill goes, but you're there. It's got a lot of twists and turns in it. And after a while, you get a little uncertain about where the top of this hill is. And you start to lose energy. You become uncertain, and in our terms, we call it the perception of risk. So you become, and this uncertainty starts to settle in on you. And you hit this plateau. And that is the level of the market. And then all of a sudden, you lose a lot of energy, and things begin to fall away. And things begin to fall away very slowly at first, and then more quickly. Then they fall away, and they hit this level again. And right now, we're coming out of that level. I believe we're in recovery. And I think that the market will begin to move up, and it actually has already moved up. So the market has, over these last 3 downturns, had the same profile. And that profile is it moves up gradually and then more steeply, and then it gets to this plateau. And it stays there. So this upward trend seems to run 8 to 10 years. Then it hits this plateau. It stays there for just a short period of time. Then it starts to decline gradually, and then it declines more rapidly. Then it hits another plateau where it stays for just a little while. And in this case, it has stayed for, well, if you count the top to the bottom, it stayed about 6 years, 5 years. It's exactly the same profile that we had back in the 90s. And some of you will remember that during the Carter administration, way back, we had interest rates of 20%. Now we have the opposite of the spectrum, the lowest rates we've ever had. So what happens is these profiles have been exactly the same each and every time. As I mentioned, I think we're in recovery. What you've seen is that sales volume has begun to increase. Days on market have begun to decrease. The last increment in this 3-part series is price. If you reverse the process and looked at what led us to this, you would see exactly the same thing. What happened was, during the summer of 2005, sales volume began to decrease. Actually, it had decreased by that time. Then we hit this plateau that I was speaking about. Then it began to decrease. So we have now an increase in sales activity, days on the market, and prices will increase, and in some cases they have increased. I was in Newcastle yesterday, and you could see that there were increases in the market. And if you do a year-on-year for the median selling price for properties in Portsmouth, you see the same thing, that there has been an increase in price. But if you start to spread that over Dover and Rochester, you don't see that yet. So what happens is the market comes in waves, not universal. So that our market is driven primarily by Boston, seems to come up 95. Then when it gets to Portsmouth, it kind of spreads out northwest, and then as it hits northwest, it kind of dribbles over the river into Kittery, Elliott, and the other places. So, and it's also interesting in that this wave is property specific. So that residential properties, condominiums for example, are residential condominiums are showing an increase. But if you applied that same type of reasoning to subdivisions, residential subdivisions, you would see that they were dogs on the market. Very, very bad. People are trying to get rid of them. Foreclosures are the mainstay. Foreclosures, except in metropolitan areas. So you find that. So the real question is, how do you spot the next one? So what you can do is not look at price. Look at sales volume. Look at these little these little increments, these little indexes that lead to the decline in price. The market becomes overheated. When the market becomes overheated, that's time to start thinking that the market may well be getting prepared for a downturn. One of the other things to look at is consumer confidence. And you can go on site and look at consumer confidence. It's published, I think it's once every quarter, or maybe once every month. And consumer confidence tracked the market pretty good. It showed that consumers generally across the country were uncertain. And this uncertainty led to the decline in market. So as the consumers become uncertain, it was indexed in the consumer price, and the consumer price fell to, I think in February of 2009, to its lowest historic level, 25. Anything over 50 is usually pretty good. The market is now moving up and has jumped over the 50-point threshold. So the market is starting to gain some energy. On a national, another thing to look at is one of the other leading indicators is the yield curve. The yield curve looks at short-term and long-term bonds. So that if the market is confident about the future, it will begin to expand where you have long-term bonds that are showing good returns. Another thing that I do, and I know that it probably sounds frivolous, but I look at the New York Stock Exchange trend line. I look at it all the time. Sunday morning, I'll open the paper and look at the business section and see where the line is. I'm not concerned with day-to-day activities, but the trend line is a confidence factor. It tells you what the public at large is doing with their investments. So, one of the things that we always seem to learn is that location is really an important concept in the valuation of property. My thought is it's really timing, and I think a lot of us would agree today that it's timing that dictates the market. That's all I've got. Thank you very much.